Assalamu alaikum to everyone. Dear student, let us discuss this question Ash, question 99. Actually, this question is on capital gain. Let's discuss this question. Just a minute. Just a minute. Let's read the requirement. It's a 20 marks question. Requirement A1 says state the conditions that must be satisfied for Ash assignment of lease to be associated disposal for the purpose of better. 3 marks. We need to discuss the conditions which must be satisfied. Then, only then, assignment of lease to be treated as associated disposal. Okay, we'll discuss. At least we know that one thing, that ownership period must be 2 years. Okay, but we'll read the question and then we'll discuss other as well. So in A part 3, there will be 3 conditions. Don't worry. Calculate Ash's capital gain tax liability for the tax year 2021 on the assumption that assignment of the lease does qualify as an associated disposal and that bidder will be claimed where possible. The following lease percentages should be used where necessary. For 37 years, it is 93.497. For 46 years, it is 98.490. Okay. Discuss in detail whether Volcan partnership may be required to register for VAT. Basically, there are 2 tests. One is historical test, another is future test. If any one of the tests passes, then it becomes compulsory to register your business. And then you need to discuss the advantages and disadvantages of the business of registration. Obviously, when your business gets registration, the benefit number 1 is you will be able to claim your input. Benefit number 2, your business looks big. Benefit number 3, the image of the business in the society becomes better, obviously. If I discuss disadvantages, obviously you have to face the burden of compliance with VAT authorities, which was not there earlier. Second, your product will become expensive. Why your product will become expensive? Because once you get registered your business with the VAT authorities, then obviously you have to add the VAT price. So VAT, because you are going to charge VAT to the customer, that makes your product expensive. So you will be having now administration burden relating to VAT. Second, products becomes expensive. So you have to face these things. Set out the matters that Ash should consider when deciding whether or not to make claim reduced payment on account of the income tax due on 31st January 2022. Actually, what happens in payment on account, we make payment in advance for the incoming income tax liability. But if in the future your business, let's say, estimates that in the future instead of increase in the income tax liability, there is going to be a decrease in the income tax liability, then you can go and claim for the reduction in payment on account. But you have to make sure that then in future your income tax liability should reduce. If it does not, then obviously you have to bear the penalties. One, you have to bear the penalty. Second, you have made obviously less payment, reduced payments. So the payment which you were, for example, you were required to make the payment of £30,000. Instead of 30, you paid only 20. So one, obviously you have to pay that remaining amount. Second, you have to pay interest on that amount as well. So you have to make sure before claiming the reduction in payment on account, because if you estimate that in the future your income tax liability will decrease, then you can claim for the reduction in payment on account, but you have to make sure that it should reduce the income tax liability, because if it does not, you have to face the penalty, and second, you have to obviously pay the difference with the interest as well. But I strongly advise all of my students, please just read answer of B and C once. I think that the answer will be available in my book. If not, then read it from the kit. But must read only B and C once. Okay. Now let's read the question. Ash requires a calculation of his capital gain tax liability for the tax year 2021, together with advice in connection with better registration for the purpose of VAT and payment of income tax. Okay. Ash is resident in the UK, had taxable income 29,000. Tax year 2021 was the owner and managing director of Lava Limited, owner as well as managing director, until 1st May 2020 when he registered and sold the company. Okay, is a partner in the Volcan partnership. Ash disposal of capital asset in the tax year 2021. The sale of shares in the Lava Limited resulted in a capital gain 2,35,000. Okay, you sold shares in Lava. Obviously, the entire which qualified for better. Obviously, it will qualify for better. You are the owner, especially you are an employee of this Lava as well. Okay, so it is already written as the gain of 2,35,000 is qualifying for better. We know that the limit of the better for the entire life is £1,000,000 and the tax rate is 10% of for better. And first we apply that tax rate on the gain which qualifies for better. And it is written in the question as well. Wherever better is available, it will be claimed. Okay, and we know that in case of annual exemption and any capital losses, we will deduct capital loss as well as annual exemption from the gain which is not qualifying for better, because over there we have higher CGT rates. If we have a space in basic rate band, which is not the case over here, then only 10% applies, otherwise 20%. So it is obviously advisable if you have unused annual exemption, it should be deducted from the capital gain which is not qualifying for better. Second loss should be deducted from the capital gain which is not qualifying for better. Okay. Ash has signed a 37-year lease on a property 1,10,000 on 1st May 2020. Ash sold 2 acres of land. Whenever examiner gives you information like this, sold 2 acres, 3 acres, it's a part disposal. Ash sold 2 acres of land on 1st October 2020. Obviously, it falls in the tax year 2021. So it's a part disposal. Ash sold quoted shares and made a capital loss 16,500. So obviously, this capital loss should be deducted from the capital gain, which is not qualifying for better. Now let's talk about the lease. The lease was previously assigned to Ash for 31,800 when it had 46 years remaining. The property has always been used by Lava Limited for trading purposes. Lava Limited paid Ash rent equivalent to 40% of the market rate in respect of the use of the property. Now listen. The point number 1 says state the conditions that must be satisfied for Ash assignment of the lease to be an associated disposal. I'm just telling you what are the conditions. Condition number 1, let me tell you the conditions. Condition number 1, disposal of shares in Lava must qualify for better. So, disposal of shares must qualify for better. Number 1 condition. Because if it is not qualifying for better, A1, okay, if it is not qualifying for better, then obviously the disposal of assignment of the lease will not qualify for better as well. The second condition is very important, the ownership. The ownership, definitely, the lease must have been owned for 2 years and it must be used by Lava for, obviously, for the trade purposes for how many years? 2 years. The lease must have been owned by Ash for 2 years and Lava Limited must have used in trade for at least 2 years. The lease must have been owned by Ash for 2 years and Lava must have used in trade for 2 years. Another thing, Ash must be selling both his holding in lava as well as the lease. Ash must sell his holding as well as lease in Lava Limited. So you need to sell both of them. You need to sell both of them. All these three conditions must be met. Only then it qualify for associated disposal. Okay, the sale of 2 acres of land. Ash purchased 8 acres of land 27 for 27,400 on June 2013. Okay, Ash already sold 6 acres of land the way back for 42,000. Okay, the remaining 2 acres of land were 18,000 at that time previously. Now we are selling remaining 2 acres of land, and we are selling these remaining 2 acres of land for 30,000. Okay. One thing, the capital gain on the land will not qualify for better, obviously. Second, associated disposal gain does qualify for better, but there's one problem. The problem is Ash has not only given that premises on rent, he was also charging. He used to charge 40% of the market rate, which means that technically, logically, 40% of that particular property was used as an investment property, and which does not qualify for better. So whatever the capital gain comes on this associated disposal, only 60% will qualify for better, 40% will not qualify for better. Repeat. Logically, 40% of the property was used as an investment property, and investment property does not qualify for better. So whatever capital gain comes on this assignment of the lease, only 60% of the capital gain qualifies for better, 40% does not qualify for better. Okay. Another thing, how do we calculate capital gain on these 2 acres? Just let me tell you an idea. The sale proceed of the 2 acre is 30,000. Okay. We just need to deduct the cost. Originally, the 8 acre had a cost of 27,400. Originally, they had a cost of 27,400. I just need the cost of 2 acre. The value of the 2 acre on 2016 was 18. I'm dividing this with 18 plus 42. So it gives me the cost of the 2 acres, which is 8220. So from 30,000, if I deduct 8220, I'm getting a capital gain of 21,780. And this capital gain of 21,780 does not qualify for better. This does not qualify for better. Okay. I'm just giving you the idea, then we'll be solving it properly. Another thing, what about the lease? Okay. Ash assigned. Uh, Ash assigned 37-year lease on a property for 110. So the sale proceed of the lease is 1,10,000. What about the cost? If I tell you the cost, this was initially taken. The cost was 31,800, and at that time the lease had a time period of 46 years, which means that we'll take cost 31,800, just multiply this with the percentage of 37 years and then divide with the percentage of 46 years, which is given to us. It is this 93.497 divided by 98.490. Okay. So 93.497 divided by 98.490, it gives us 30,000,180, which means the chargeable gain on the assignment of the lease is coming 79,812. And out of this capital gain, 60% qualifies for better and 40 does not qualify for better. So now let us solve this properly. We need to calculate capital gain tax liability A2. CGT liability. So let me show you one working over here. We are working this on land. Disposal proceed. Disposal proceed is 30,000. Let us deduct the allowable cost. Allowable cost. 8 acres of land, dear student, they were bought for 27,400, and when they sold 6 acre at that time, market value of the 2 acre was market value of the 2 acre was 18,000. 18 plus 42,000. It gives you 8,220. From 30,000, if I deduct 8,220, I'll get the chargeable gain of 21,780. And this is the chargeable gain which is not qualifying for better. Chargeable gain, which is not qualifying for better. If we go for working two, relating to, I'll show the working two here. Obviously, you have to solve on Excel, and you can very neatly show the working each and everything on the Excel. Working two, gain on assignment of the lease. Gain on assignment of the lease. Sale proceed is 1,10,000. Sale proceed is 1,10,000. Let us deduct the cost. Allowable cost. Initially, the lease was taken for a cost of 31,800. For 37, the percentage is 93.49. And originally, we Ash took for 46 here. At that time, the percentage was 98.490. So we'll get 30,188. Here comes the chargeable gain. Entire chargeable gain does not qualify for better because Ash was charging 40% market value of the rent as well. So logically, 40% is not, the 40% of the gain is not qualifying for better, but 60% is qualifying for better. So now let's go for the presentation. For dear student presentation, we have to make two columns. One better, which is qualifying for gain, qualifying for better. Another gain, which is not qualifying for better. So simply gain qualifying for better. Gain does not qualify for better. Does not qualifying for better. So we have two gains, one which is qualifying for better, another which is not qualifying for better. Examiner has already given us gain on shares 2,35,000, which is qualifying for better, and that gain belongs to the shares sold in Lava Limited. Gain on shares. Gain on shares 2,35,000. Gain on sale of land, we have just calculated gain on sale of land. Working one. It was, I believe, 21,780. And this is the gain which is not qualifying for better. Now, gain on assignment of the lease, 60% qualifies for better, but 40 does not. Gain on assignment of lease. Gain on assignment of lease. The amount of the gain is 79,812. 79,812. 60% is actually qualifying for better, 40 is not. So we have 60-40 ratio. And you need to explain this to examiner as well. Simply in note 1, you have to just write that entire capital gain on associated disposal is not qualifying for better because Ash was charging 40% of the market value as rent. 40% he was taking whatever the market value of the rent was, he was taking 40% of that. So only 60% qualifies for better. So if you take 60% of 79,812, you will get 47,887. And obviously, if I deduct 47,887 from 79,812, so I'll get 31,925. Next, we do have a loss in the question as well, as we discussed just right now, that loss on disposal as well as annual exemption will be deducted from the capital gain which is not qualifying for better. So loss on the sale of quoted shares, loss on sale of quoted shares, it is 16,500. So we don't have any other information. So just use the calculator. 2,35,000 plus 47,887 gives you 2,82,887. So 21,780 plus 31,925 minus 16,500 gives us 37,205. Now annual exemption will be deducted from a gain which is not qualifying for better. So annual exempt amount is 12,300 deducted from a gain which is not qualifying from better. So we will get taxable gain. Let's get the taxable gain. This is 2,82,887. From 37,205, we'll deduct 12,300. We'll get 24,905. When it comes to calculating the tax rate, first tax rate is applied on a gain which is qualifying for better, and that obviously consumes bands as well. So let's calculate capital gain tax liability. So first it is applicable on a gain which is qualifying for better. 2,82,887, we have to take 10% of that. Obviously it comes 28,288.7 if we do a little bit round off. So we'll get 28,289. Then 24,905, obviously the tax rate is 20% because we have no more space in basic rate band which is already consumed due to gain qualifying for better. So if we take 20% of 24,905, we'll get 4,981. So here comes your CGT liability. This is, dear student, your CGT liability. So 2,82,887 into 10% because this is the gain which is qualifying for better where the tax rate is 10%. Other gain is not qualifying for better and the applicable tax rate is 20%. So CGT liability is 33,270. CGT liability is 33,270. Pure and simple. I need to discuss one more concept. Okay. Of chattels. Just a minute. I hope we have the information. Yes, we have. Just give me a minute. Let's see what happens. Chattel topic is very small, very small. Because in ATX you just need to have a little bit information about this. Chattels and wasting assets. It is important to be able to identify a chattel and wasting asset as there are special rules calculating gain or loss. Okay, chattels. Chattels are defined as tangible movable property, for example, a picture or table. Note that asset must be movable, therefore building is not a chattel. Obviously, building does not move. Tangible, therefore shares are not chattels because shares they come in intangible. So when it comes to chattels, so chattels are defined as tangible movable properties. For example, it says picture, table. Movable is more explained over here. Therefore, building is not a chattel because it is not movable. Tangible, therefore shares they don't come in chattels because they are intangible. Wasting assets. A wasting asset is an asset with a predictable life not exceeding 50 years. Chattel may be wasting or non-wasting. Wasting means the life is not exceeding 50 years. Non-wasting means the life is exceeding 50 years. Expected life not exceeding 50 years means wasting chattels. Non-wasting chattels more than 50 years. Let's talk about wasting chattels. Not exceeding 50 years. Examples. We have greyhound, which is a I think type of dog if I'm not wrong. Greyhound, oath, plant and machinery, and race horse. Okay. These are the example of wasting chattels. Now let's talk about non-wasting antiques, jewelry, paintings. Plant we in case of plant and machinery, we normally assume that plant and machinery they come in wasting chattels. Plant and machinery are deemed to have a useful life of less than 50 years and they are always wasting chattels. Now, look at this. Chattel exempt disposals. Certain disposal of chattels are exempt from the capital gain. Exempt disposal. Wasting chattels. Wasting chattel means we just discussed where the life is not exceeding 50 years. Exception. Chattels eligible for capital allowances. Plant and machinery used in a business. Unless bought and sold for 6,000. Now listen. If there is a plant and machinery. If plant and machinery is bought and sold for less than 6,000, then it is exempt. If plant and machinery is bought and sold for less than 6,000, obviously, plant and machinery is a wasting chattel, yes. But if it is bought and sold for less than 6,000, then it is exempt. But in case of plant and machinery, you need to remember one thing. Plant and machinery which qualifies for capital allowances. Then capital loss does not arise. Then capital loss does not arise. If plant and machinery is sold on capital gain, if the capital gain comes, there's no issue at all. But for example, if let's say question says the owner has bought plant and machinery for 2 lakh pounds and they're selling it for just 70,000. So you can't do that. You cannot deduct 2 lakh from the 70 and take out the capital loss because this plant and machinery is qualifying for capital allowances. And in the past, business has already taken the capital allowances, and on that capital allowance, they have already received the tax. So tax authorities will not give you the permission again by calculating the capital loss. Obviously, you will be saving tax again. So simply you need to remember one point. The plant and machinery which qualifies for capital allowances, if it is sold for a loss, then capital loss does not arise. If it is sold on a capital gain, then it is okay. Gain can come. Okay. Other point which you need to remember, if plant and machinery is bought and sold for less than 6,000, it is exempt. Non-wasting chattels which are bought and sold for less than 6,000, it is exempt. So dear student, for chattels, you just need to have a little bit idea about the chattels wasting as well as non-wasting, and little bit about this 6,000 rule. If wasting chattel is sold and bought for less than 6,000, it is exempt. And non-wasting chattel is bought and sold for less than 6,000, it is also exempt. And for plant and machinery, dear student, you need to remember one rule. What is that? If the plant and machinery which is qualifying for capital allowances, if it is sold on a if it is sold on a loss, then capital loss does not come. If the plant and machinery which qualifies for capital allowances, if it is sold on a capital gain, then capital gain can come, no issue at all. But in case of plant and machinery on which you are getting capital allowances, it cannot result in capital loss. So dear student, in this small lecture we covered the question ash as well as we did cover this chattel area also. It's very small in ATX, it's not big at all. So simply, thank you very much for watching this lecture. Assalamu alaikum to everyone. Have a nice life.